Coming up today, the S&P hits a new record. Alphabet crosses 3 trillion valuation. Why is Tesla ripping today? The hottest small cap stocks. More crypto ETFs on deck. The US boosting its uranium reserves. What's the Fed going to do this week? More economists get worried. And everything else to get you prepped for another big week on Wall Street. We've hit a turning point here, guys. Let's go. And welcome back, my fellow optimists. I hope you're all doing well out there. Off to a pretty solid start here on Wall Street, but it doesn't really look like it according to the heat map here because we've actually got a massive rotation out of the defensive sectors, healthcare, once again into mega cap tech with Google and Tesla leading the charge. Even more impressive today is small caps, like I'm about to show you later on. And we do have a big week, quadruple witching, third Friday in the last month of the quarter. We'll no doubt set a record in the amount of options expiring this Friday. We got retail sales tomorrow, housing data, and the very important Fed meeting this Wednesday, which Jay Powell is widely expected to cut rates by at least a quarter point, but more on that later. Fear and greed index has just slipped back into the greed zone after we closed on Friday neutral, coming off the back of still quite a lot of skepticism and bearish sentiment out there, like we saw in the surveys last week. Because why is the market going up? It's September. It's supposed to be the worst month of the year. Or will we possibly sell off after the Fed's rate decision this Wednesday? That's something else we're going to look at later. But so far, the market appears to be chugging along as usual. We're up a bit over 10% year to date after having that almost 20% drawdown. Not all that out of the ordinary looking back over the past 45 years. And just looking at the length and severity of prior bear and subsequent bull market. Here we are in the green line. Technically, you can make a case we had a bear market already this year. S&P did come off 20% from highs, the Russell 30%, meaning the technical definition of a bear market. But others say it was 2022, the last proper bear market we had. Didn't last quite a year. Here we are in the green line, and I think it would catch a lot of people by surprise if this bull market did extend for another couple of years, like we've seen in the past. But the calls for a recession are growing louder by the day, and that's because there is data there to support that. Something else I'll show you later on. But right here in the now, we've got an incredible amount of technical momentum in the stock market, especially in AI-led names and small cap growth stocks, really lighting up the last couple of weeks. And that's because companies are making huge productivity gains, the likes we haven't seen in years. After productivity kind of went sideways for about 15 years, after massive gains in the 80s and 90s, thanks to the growth in personal computers, the internet, mobile and cloud, now we've got AI, big data and automation, unleashing even more productivity gains across the board. And one of the biggest and best companies leading the charge in the world, Alphabet Google, hitting 3 trillion market cap for the first time ever, and only the fourth company in history to do so. And it was only a couple of months ago there was a strong narrative that they were behind on AI. However, if you were locked in with this channel, Click Capital, you would know what I was saying the whole time, that they're actually a leader. And so every now and then, the market has a divergence in perception versus reality. And the reality is, Alphabet has the best AI model, in addition to the best networking and scaling effects, the largest advertising infrastructure, over 4 billion installed users across their ecosystem, not to mention challenging GPUs with their own TPUs and their dominance. In the browser market, video, huge growth in cloud, the list goes on. And now we've actually seen signs their AI chatbot Gemini has been growing faster than GPT over the last couple of months. People really using it more and more thanks to their latest image editing tool, Nano Banana, which I've tested it out and can say for sure it is the best when it comes to using AI to create, edit, and enhance digital images. And they actually overtook GPT in the most downloaded free app in the Apple App Store over the weekend. And it looks like once again the market is taking note, crossing 250 a share for the first time ever, up 4.5%, such a huge move for a mega cap tech. With Apple currently at 3.5 trillion, I think there's the real possibility Alphabet overtakes Apple in the coming months. Still a little bit of work to do though to catch up to NVIDIA, 4.3 trillion market cap. But Alphabet has well and truly overtaken Meta, still at 1.92 trillion market cap. Also catching a bid there today, Tesla. On news, Elon Musk just bought $1 billion worth of stock, the first time he's made a purchase in over 5 years, since February 2020. And that's probably because Elon, like the rest of us Tesla shareholders, are excited about what's right on our doorstep and around the corner for the company. I would say this is the most exciting time for Tesla shareholders. The last 10 years has largely been a story of their huge growth in electric vehicles, making the Model Y the best-selling car in the world. But now with robotaxi, optimist bot, full self-driving, semi-truck, their energy storage business, and a few other bits and bobs like the Tesla diners, is getting the man at the top excited as well, as he posted on his social media network today. Tesla's up $69 to $420 as foretold in the prophecy. And just on a side note, thank God Elon Musk did buy X, which is now the true town square, allowing for open and free uncensored speech. And once again, the market loved that news, gapping up to 423 this morning, before pulling back a little bit into close at 410. No doubt a little stretched here in the short term, but not all that far off all-time highs, 488. And we've now almost doubled off the lows around 220, like I told you guys back on the 11th of March when I last bought the dip. Now on a market cap of 1.3 trillion, still a month out, Q3 earnings, and I think we may get a little bump up in EVs thanks to expiring tax credits. But the most important thing will be the progress in robotaxis being rolled out across the country. But looking beyond the biggest companies in the world, where else could there be opportunity in the market? Well, according to Pacer ETFs, they think investors should also look at small and mid caps, as we've seen a bit of a catch up these past few weeks that could only be starting. There's plenty more room for small caps to catch up to large caps. We still don't have the Russell 2000 at all-time highs yet. And one thing that gets me really excited to stay invested in small caps going forward is the market is simply underallocated to them. And I've seen this so many times. It's almost like the market and fund managers give up on a certain segment, a certain sector, and that's usually the most fertile time to get in or increase allocation. With US small cap ETFs only making up about 6% of the entire domestic equity ETF market in terms of assets under management. That is incredibly low, and now we're starting to see a lot of momentum in small cap growth stocks. And I was pleased to see the latest issue of the Investors Business Daily in their IBD 50 list, a widely followed list of 50 companies meeting their CAN-SLIM criteria, popular growth investing method created by their founder, William O'Neill, who wrote the book, How to Make Money in the Stock Market. And their criteria looks at revenue and profit growth, relative performance, and so on to rank stocks that are performing the best overall. And I was pleased to see a company I own in my stock picks portfolio come in at number one. That's Iron, which you could think of as a GPU landlord, and also showing up InnoData, which we've also got in our portfolio. And these data center stocks are just lighting up once again today. Iron up 9.3%, and InnoData also on a good run here, up almost 5%. And just looking at the sector, the Global X Data Center and Digital Infrastructure ETF, that's only just breaking out of yearly highs. So it doesn't look all that stretched looking at the sector ETF. And there's plenty of fundamental momentum back in it. The spending on data centers just continues to accelerate. And this is still early days as well. Phase one of the AI revolution is the infrastructure build out, which it appears we're still in the thick of. And after the infrastructure build out, I think the next phase will be AI manifesting itself in the physical world in the form of robots. We've seen one of my favorites, Rich Tech Robotics, rip up again today on speculation they may be partnering with McDonald's. And this video is a few months old, but it's what McDonald's does. They test out new technology in just a couple of stores before rolling it out. And that's a robot from Rich Tech, Maitre D. They've got a number of different robots used across different industries. And of course, that's speculation yet to be confirmed, but they did just announce a bit over a week ago they had signed a new partnership with a large retailer. And this is definitely getting more and more onto retail traders' watch lists. Stock up over 18% today on big volume once again, 73 million shares. And I haven't sold a single share, and I don't plan on doing so until it hits double digits. And even then I'll hesitate because I know when I do sell some shares, I won't ever get back my cost average on those shares, around $2. And like I told my options members back on the 23rd of June, when I last bought the dip at $1.74 a share. And as I told them back then, I believed it was a huge asymmetrical investment with way more upside than downside. And that's because I think robotics is the biggest revolution of our lifetimes. So I've got 40,000 shares in Rich Tech, and I wish I actually held more. And I plan on holding a core position long term. As long as the business keeps growing and succeeding, that's what I'm focused on. And this is a massively volatile stock, so there will be huge amounts of volatility and potential 50, 70, even 80% corrections along the way. And that's the hardest thing to do, is to hold throughout all that volatility. But like I said, I'm more focused on the business growth than I am on the stock price. And Rich Tech is really the only US focused pure play on robots. And I think going into the massive launch of Optimus, Tesla's humanoid next year, which I think will be the biggest product of our lifetimes, that could ignite a monster rally and robotic related stocks going into that. So again, this isn't a swing trade for me. I'm in it for the long run, just like I am with my position in the Global Robotics and Automation Index ETF Robo and my long-term buy and hold portfolio as well. Also looking pretty good on the chart here, but just moving on to crypto for a bit, as we've got a few crypto miners pivoting to offer their compute power for rent, being led by the likes of Iron. We've also got a huge amount of demand for Bitcoin ETFs. In fact, over the last 5 days alone, the net inflows into Bitcoin ETFs is almost 10x that of the new supply from mining. And now in total, the 11 biggest Bitcoin ETFs hold over 1.3 million Bitcoins. That's over 5% of the total supply of 21 million coins, with the largest being BlackRock's iShares Bitcoin Trust, IBIT, now a whopping 86.8 3.6 billion assets under management, and that has grown more than 4x over the last year. This time last year, 20 billion, and there's more to come. We could very well be seeing the first Dogecoin ETF trading this Thursday as the SEC signs off on more and more crypto product, and we should be getting crypto ETFs that allow staking, offering a yield, which will no doubt be very appealing to many investors and allows for compounding. And we're still actually in the midst of ETFs eating mutual funds. Assets under management and mutual funds actually peaked out in 2019, and even though markets have grown a lot in that time, they've actually seen declining numbers in funds under management, and that's thanks to people withdrawing from mutual funds and reallocating to ETFs, much more transparent and liquid than traditional mutual funds. And so ETFs are currently on track to overtake mutual funds worldwide in 2027 with more assets under management, and that lead will continue to grow well and truly going into the 2030s. Quickly on their way to becoming the gold standard building blocks of wealth. And we are on track for a record year of inflows into ETFs. Over $500 billion coming in the first half, and we very well could hit that 1.2 trillion total net inflows into electronic traded funds this year. In fact, there's now more ETFs than stocks in the US, over 4,000. And that's because US listed ETFs can give you exposure to just about any asset in the world. And now the huge growth in strategy-based ETFs, in addition to crypto, and more international funds coming on the market every month as well. And it's actually those international funds that have been some of the best performing this year, especially some of these smaller European countries and even a few out of Asia as well. South Korea and Singapore doing really well. And one country ETF that could be next to catch up, Chile, which you could think of as the Saudi Arabia of copper, with Chile head and shoulders above the rest of the world in terms of annual production. And we've actually seen some pretty good price action in the copper miners ETF of late, and that's COPEX. Going on a bit of a run here as the underlying commodity has been underperforming, but miners have really been catching up of late across all commodities. Yet the Chile ETF still hasn't quite done so, but we are getting some signs of accumulation here. Relatively small fund at 734 million assets under management and looking pretty good there on the monthly chart. Been underperforming for a long time. Big multi-year base that looks to potentially getting tested here soon. But the best performing commodity today by far, none other than my favorite, uranium. As I've been saying, expect more headlines coming from the government, and we got a zinger today. Coming out of Energy Secretary Chris Wright, emphasizing the need for larger uranium stockpiles as part of a comprehensive strategy to revitalize America's nuclear sector amid increasing electricity demands and geopolitical tensions. So we're going to see the US government get more and more directly involved in the uranium market and building up a stockpile of reserves, whilst also reducing dependence on other countries. And this comes on top of the US and Britain signing a flurry of major nuclear power deals with the US president currently on visit there. The goal is to put both countries at the forefront of global innovation, and as part of the agreement, there are plans to build 12 advanced new modular reactors. Remember, that's what I've been talking about as the next stage for nuclear's growth. Instead of the big nuclear power plants, modular reactors, built to order, run on site, way quicker, way cheaper, and that's what we're going to see a lot more of as we finally go into the golden age of nuclear, the best form of energy. Absolutely needed to power the huge demand in electricity from data centers. And that's what caused a sharp rip in the Global X Uranium ETF today, up 9.35%. Like I told you guys last week, it was looking pretty good for a breakout. That's why I put on a bullish options trade that I shared with my options trading members, helping us once again have a very profitable day today. In addition to another stock we've got a bullish position in, energy fuels. With that too breaking out 15% and helping some others in the industry. Another one I've got on my stock picks portfolio, Nano Nuclear Energy, up 13% today. And other standouts, the world's largest uranium miner, Cameco, breaking out in volume. And of course, no surprise to see the modular reactor companies like Oklo rip up there today. And the relevant ETF, the Nuclear Renaissance Index. And this one's actually in my new ETF portfolio. I'm currently running it as a model before I go live with it at the start of next month. And that portfolio is also having a fantastic month. So no doubt we've got plenty of momentum out there going to the all-important Fed meeting this Wednesday. Fed widely expected to cut rates for the first time this year. After J. Powell did start an easing cycle this time last year, September, then he abruptly stopped. And like we've been saying for the last couple of months, he needs to get a move on because the jobs market is quickly weakening. Millions of struggling consumers, but he actually may be doing a favor for the stock market who may not be so worried about the jobs market. But no doubt it's got people talking because it's a common misconception the Fed only cuts rates when we're about to go into a recession. And even though we are getting those recessionary signals of a weakening jobs market, the stock market doesn't seem to be all that worried. And so we're pretty much guaranteed to get a cut this Wednesday. Still a small chance we could get a 50 basis point cut if the Fed wants to start off strong, maybe catch up for a cut they should have done in July. I wouldn't rule it out. And according to Goldman Sachs, they think we're going to get a quarter point cut and they're actually going to get 2 more this year. So we could very well go into 2026 with overnight rates on a low 3 handle. So it's really going to be interesting what happens in the jobs market, consumer spending, and the stock market going into Q4. Because like I said, we can still see the stock market power ahead when the Fed cuts interest rates while the S&P is within 2% of an all-time high. In fact, every time it's done that, stocks are higher a year later, a bit better than average too, about 14%. But like Goldman Sachs says, if the jobs market keeps weakening, that could cause a lot of worry amongst investors. I think it's already happening. And that's why we're seeing those bearish sentiment surveys. But no doubt, there's a lot of data pointing towards a pending recession, with once again an army of economists, in addition to Wall Street banks, sounding the alarm. We're about to head into a recession. The economy is going to contract. After UBS came out last week and said there's a 93% chance we're going to get a recession, Moody's coming out today saying the odds of a downturn in the next 12 months are uncomfortably high. And we can see that in their recession model, the probability of a recession in the next 12 months based on machine learning. Last month that was showing at 48%. Every time it's gone above 50, we've gotten a recession. Or is it going to be like the yield curve where this time actually is different? As the consensus in finance, those are forbidden words. So again, interesting times. We're kind of in a fork in the road. And I'm not saying we can get a recession, but I think it's plausible. It may be wrong or at least delayed, just like the yield curve was for a few years, because there was an overriding consensus in Q3 2023. We're on the cusp of a recession. Didn't happen. But no doubt, consumer sentiment is weak. The real test is going to be if unemployment rate continues to climb, goes above 5%, but consumer spending still holds up. The top 10, 20% of consumers could continue holding up the economy and the market. It's kind of a self-reinforcing cycle. If stocks stay high, so does consumer spending from those at the top. I mean, just looking at the balance sheet of consumers in the States, they've never been more rich. Over $190 trillion in assets and only $20 trillion in liabilities. Capitalism could come to a grinding halt, and all these wealthy boomers have still got trillions to spend in the economy. They don't need an income. They don't need a job. Not to mention the effects of AI and robots. And plus, a large amount of this wealth is going to filter down to millennials, the biggest transfer of wealth in history. That's why we've got stocks like Robinhood holding up really well, because they're set to benefit from all of that. They've got more millennial customers than every other brokerage firm combined. But on the same hand, a large correction in the stock market could become self-reinforcing, causing all the wealthy consumers to pull back their spending. And maybe that's what we need to get a recession. Stock market pulling back 20-30%. But we have been getting a bit of an everything rally of late. Even bonds have been ticking up, and gold having one of its best years ever. And no doubt there's a few things going on here, not just a flight of safety, but I'd say the biggest driver is de-dollarization. Foreign central banks piling into it, trying to get off the US dollar. Now we've got the prospect of lower rates, in addition to widely perceived inflation risks. No real surprise to see assets under management and gold ETFs explode higher this year. And I'm definitely not calling a top in gold, because I would never fade momentum like this, but there's a little stretched here on the long-term 3-monthly chart. Very well could hit 4,000 this year, but for the here and now, I'm preferring silver, which still has not hit all-time highs, especially adjusted for inflation. We'd have to go above $70 an ounce to hit a new inflation-adjusted record, and silver miners have got even more to go, one of the best performing sectors this quarter. But if you think about it, the low crude oil price is not only helping commodity miners, making it cheaper to dig stuff out of the ground, just like the weak US dollar, low oil and a low dollar is a form of financial easing and stimulus for the economy and the stock market. Half of the Nasdaq's earnings come offshore, so the lower the dollar, the higher earnings per share when those funds get repatriated. And oil is the biggest cost input into the economy, and now we're going to get extra stimulus in the form of lower rates. I'd say Scott Bessent has got a big smile on his face. US Treasury Secretary is getting his cake and eating it too. His mandate is lower dollar, lower oil, lower rates, accelerate American exceptionalism, onshore important industry, and those are some big tailwinds for the stock market. So like I said, interesting times. No denying the fact the jobs market's getting weaker, and that is usually a signal for a recession. But we got a lot of signals back in 2023 as well, and I'd say the AI boom overwhelmed all of that. Can it do it once again? Q4 is setting up to be really interesting here. And even though the indices were up today, S&P up 0.5%, Mag 7 leading the way thanks to Tesla and Google. Russell 2000 also shaping up just under all-time highs going into Fed decision Wednesday. We are getting a little uptick in volatility. Option dealers marking up their implied volatilities a little bit, but still pretty low here, under 15. This Wednesday will certainly be interesting. Not only the decision from the Fed, but Jay Powell's commentary. I think he'll most likely do a quarter-point cut and just leave the door open for another cut in October and December. But once again, say he's completely reliant on backward-looking data to make his forward-looking decisions. So this week will certainly be interesting. Make sure you stay locked in here with Click Capital, and I'll keep you updated every day after market close. And as a reminder, I'm launching my brand new ETF portfolio service next Thursday, along with a big discount for founding members. And you can follow my Real Money account and get all my buy and sell decisions the day before I make them, along with transparent tracking and a private members area. If you'd like to learn more about that, click the link below this video and get my free ebook before I pull it down later this week. Otherwise, thanks very much for watching the show. I'll be back again this time tomorrow. Cheers.